I waited until the morning of the test to study for the test. That was funny. Chapters 12 and 17. Chapters... Oh no. Come on. Stop. It's better to study the homework problems that we did in class because those are probably more likely to be the types of questions that could be on a test. So anyways, I didn't do anything for these. Wow, so looks like there's only 2 sheets here for this. So here we go. 12-1. We have all the way until around 9:45 to study. That should be enough time, hopefully. I'm going to have to kind of go a little bit more quickly through the studying than usual. But these 2 chapters are actually kind of easy. So it's intangible assets and investments. So we have exercise 12.1. Oh man. Right. Number 1. Classify these as whether they're intangible assets or not. Investment in a subsidiary company is long-term investment. Timberland is a capital asset. Capital asset? That doesn't make any sense. Shouldn't timberland not be a capital asset because it's used in the if it's used in the business, then it wouldn't be classified as a capital asset. It would be classified as a not capital asset. Okay, whatever. Timberland. Why is timberland a capital asset? You gotta be kidding me. Hopefully it's like drop-down menus for this if you have this type of question. Okay, cost of engineering activity required to advance the design of a product. Is it R&D expense? Lease prepayment. So we have a thingy. It is prepaid rent. Cost of equipment obtained is going to be equipment. Capital asset. I don't know why he's calling these capital assets. It doesn't make any sense to call them capital assets because I thought if it's used in the business, it's not capital. Cost of searching for applications of new research findings, R&D expense. Number 7, costs incurred in the formation of a corporation is going to be like startup expenses or something. Or startup. It says expense 7. Operating losses incurred. Operating losses. So startup expenses. Right? 8. Well, he calls it a loss. That's fun. Number 9. Training costs incurred in startup. That's going to be startup expenses. And then 10. Purchase cost of a franchise is going to be franchise, intangible asset. Goodwill generated internally is going to be not reported. 12. Cost of testing and search for product alternatives has got to be R&D expense. Number 13. Goodwill acquired in the purchase of a business is going to be goodwill, intangible asset. Cost of developing a patent. Is it going to be, dang, I don't know, R&D expense? Oy, oy, oy. Okay, I gotta remember. That's kind of a hard one for some reason. Cost of developing a patent is R&D expense. 15, cost of purchasing a patent is going to be intangible patent. Legal costs incurred in securing a patent is intangible patent. 17, unrecovered costs of a successful legal suit to protect the patent is going to be intangible patent. 18, cost of conceptual formulation of possible. That's got to be R&D expense. Come on. 20, not cost of purchasing is copyright. 20, research and development costs is R&D expense. 21, long-term receivables is long-term assets. Developing a trademark is R&D expense, apparently. So, like, if you develop a patent or a trademark, the cost of developing those things is R&D expense. Weird. 23, cost of purchasing a trademark is intangible trademark. So the kind of hard ones are, well, the cost of developing a patent and trademark is an R&D expense. And weirdly, he calls certain things capital assets, which is very confusing to me. But okay. 12.4. Oh, great. Oh, great. I think I did the question wrong or something. Number 1. Purchased a patent. 10 years life. Okay, I think I know how to do this. Oh yeah, and like impairment of intangible assets is going to be kind of annoying to deal with. Because I'm going to get confused which test is supposed to be used to test for impairment. I think the test for impairment depends on whether it's limited life or indefinite life. If it's limited life, you could do the test of like future cash flows generated from it, and then if it's indefinite life, you just do the test of fair value. I think that was funny. So, and goodwill testing for impairment, I think it's the fair value test. Maybe I should look into that, because that's probably something I need to know. That was fun. Impairment procedures. Give me a summary, please. Here we go. Limited life is going to be recoverability test, then fair value test. Indefinite life, other goodwill, is the fair value test. Goodwill, fair value test on reporting unit. What is the difference between those two? Man. Oh yeah, there might be a confusing question about how to calculate the goodwill, because, oh yeah, the impairment of goodwill is kind of confusing. It's very confusing. Dang it. Man. 12.4. Okay. So it's very easy. What you do is you calculate the amortization over the period of time from January 1st, 2018 to... So you calculate the you have amortization for 2018 and 2019 based on the original 10-year life. Then for the 2020 amortization, you take the carrying amount, and then you divide it, and then now they've determined that it will last only another 4 years instead of another 6 years. So divide the carrying amount by 4, and then you report that. So for number 1, you divide by 10, then first 2 years is 2,000, so carrying is 800,000. What is deep? Idiot. That's supposed to be amortization, you moron. So we have carrying. Oh, hold on a second. Wait just a minute here. Wait just a minute. I'm confused. What? What are you doing? Oh, so now you divide this by 4. You get 200,000. I'm an idiot. I labeled it depreciation. It's supposed to be amortization. Then you subtract that and you get your carrying amount. So there you go. What's all this stuff at the bottom? Book value. Yeah, I did it correctly. I don't know why I had to write the solution underneath it. Okay. So I know how to do number 1. Number 2. Alator bought a franchise for $400,000. Carrying amount was that? Had an estimated life of 30 years. Okay. So it will be retained. So it looks like it will be able to be used. It's at 400,000 at the beginning of 2020. It will be able to be used until 2028. And it's weird because you include the year 2020 in it, so it's not 8 years, it's 9 years of depreciation. So divide 400,000 by 9, and that's how you get the answer for 2. 400,000 divided by 9 equals this. What? Oh, gotta be kidding me. That's not correct. The way I did it myself was wrong. How is that wrong on me? How come it's divided by 10? Come on. This makes no sense. This makes no sense at all. How come it's 30 years? So they do it by 10 years instead. What? Okay, wait a minute. I think what they're saying is you include the year 2019 in it. You include the year 2019. Because they bought the franchise. Okay, so don't look. Are they just saying that they reported it wrong? Just go back and fix it. What they should have done is they bought it for 400,000 and a remaining life until 2028, but they didn't even know that until 2020. They're saying for this question include 2019. Crap. This divided by. What are you doing? There's 2 years. You know what's hilarious? The teacher said you can do this in 2 different ways. Divide by 30, divide by 10. For year 1, it's 30. It's 30 years. For year... What the heck? So for the first year, it's 13,333. The second year, you take the carrying amount, then divide it by 9 because there's 9 remaining years. Okay, so the professor stated that the question is very ambiguous because you could do it one of two different ways. The first way, you assume for the first year depreciation, you assume that it has a useful life of 30 years, and for the second year, you assume it has a remaining life of 9 years. Or you could say that the first year of depreciation, or you start the depreciation from 2019 and automatically start doing it by 10, or assuming with 10 years. But apparently the way I did it was wrong. Because what I did was I just ignored 2019. Okay, so I understand too, I guess. Hopefully there won't be a question that's that confusing on the test. On January 1st, 2020, incurred organization costs of this. $275,000. Duh. That's simple. 4. Purchased the license for distribution of a popular consumer product. Indefinite period of time is going to generate cash flows. So, license. And the license has an initial term of 5 years, but pay a nominal fee. Can renew a license indefinitely. Do you amortize indefinite life intangible assets? No. You do not amortize them, so it's 0. Good. 1211. 1211. We have, Goodwill is great. I hate Goodwill, dude. Oh, jeez. Because sometimes the book's questions are so confusing about Goodwill. Oh yeah, I remember doing a very complicated calculation for Goodwill on one of the homework questions. Man. We have all these. Here's the balance sheets. Balance sheet. Land is undervalued by 30,000. Equipment is overvalued. Sell the gallery. Gallery? Okay. So they bought it for $350. So report everything the same except land. You report land at 100,000. Why is this over here? Report land at 100,000. Report equipment at 170. So cash is the same. Land, buildings, equipment, copyrights 30,000. And then we have accounts payable 50,000, notes payable long term. Okay, so we have reported, we list all of the assets and liabilities, and then you have your cash that you paid for all that stuff, and then the difference between all these and all these is going to be goodwill. That's pretty clear. It's not that hard. This is an easier goodwill calculation, but there's like a harder one that I need to try to figure out because, anyways. So that's pretty easy. Hopefully, did that right. 1212. Come on. I wonder if this is going to be a harder goodwill question here. There's 250 cash and a note payable. Oh, jeez. Oh, jeez. They issued a note payable. Wait, what does that even mean that they issued a note payable? Okay, so they gave them a piece of paper that says, we will pay you $100,000 later. I think that's what that means. Oh, man. So we have the balance sheet. Prepare the July 1st entry to record the purchase. So when they purchase, you will list everything the same except fair value will be different. Or I mean, a few things will be different. So cash is $50,000. Accounts receivable, $90,000. So inventory is listed at $100,000, but we were listed at $125,000. Land is listed at $40,000, but we will list it at $60,000 in the exchange. Buildings is the same, $75,000. Equipment, $70,000. Trademarks, trademarks will be listed at $15,000. And then we have accounts payable, $200,000. Cash, we gave them cash of $250,000, and since we gave them a $100,000 note, that means we have note payable, right? Notes payable, $100,000. Good. So then you take the difference between these and everything and list it as goodwill. And also, if you got it at a bargain purchase, you have a bargain purchase, instead of listing goodwill, you list it as a gain somehow. I don't remember. Oh, man, like maybe I should look that up. Like goodwill. Let's see. I want to see how you do it if it's a bargain purchase. I hate this. They don't even say how to list it. Gain on what? Gain on something or other. Oh, jeez. Come on. Not even. So that's the same as the last question anyways. But there's a part B. Now we have to record the amortization of intangibles. So, let's see here. We have trademarks. Trademarks, indefinite life. Right? Oh, crap. It literally says no. Okay. So, trademark. Trademarks. That's the only amortization we have to record. So, we have 15,000. And so we bought the trademark and it was at 15,000. We have to record only part of a year of amortization. That was funny. So we have subtract 3,000. So we have 15 minus 3,000 is going to be 12,000. 12,000 divided by 4. And then we multiply it by what? We multiply it by half of a year. And that's how much of amortization it is. So it's going to be, I keep saying yearly depreciation, but it's not. 3,000, and that's that. So we have amortization of that, clearly. By 4, half of this, amortization, expense, trademarks. Okay, I got that. Hopefully we don't have any harder questions. I'll look through the other thing, but okay, we have still 2 more questions to look through. And I think I did these right. Let me double check the email because we didn't do this in class because we had to skip class for some reason. Or no, we didn't. I think he just gave us a class off because we had an extra class session to review for a test. But anyways, A, loss on impairment, 1.1 million. Copyright, 1.1 million. B, amortization expense, 320,000. Copyrights, 320,000. C, no entry. So I did 12.13 correctly. Let's see if we did 12.16 correctly. A, I listed R&D expense and income statement. That's all I wrote for A. Okay, what on earth am I talking about here? Okay, it says, what account should be charged for $325,000? I said R&D expense. It should be shown in the income statement. Let's see what this says. it says either separately disclosed in the income statement or separately disclosed in the notes to the financial statements. Okay. B is going to be R&D expense 110, cash 110. Cash / accounts payable or whatever. Patents. Next one is patent 16,000, cash 16,000. And the next one is amortization expense 3,200, patent 3,200. Okay, and C is patent. Well, apparently it's patents, plural. But anyways, patents 47,200, cash 47,200. Looks like I did that part right. And then we have C, amortization expense 7,500, patents 7,500. D, R&D expense. All right. So looks like I did all those both of those questions correctly. So now we will actually go through the questions. 12.13. We have copyrights. I was able to do these questions without any help at all. So, I mean, you would think I would be able to do these questions without having to study it. But let me just look through it. Record impairment of the asset. So, we have a definite life, therefore you check the expected future net cash flows of 4 million compared to carrying amount. It's less than, so there. Then you subtract 1 million. You subtract the fair value. You have a loss of 1 million. So what is it going to be recorded as? What's the journal entry? I need to come up with this on my own. So you have loss on impairment of 1 million. Or no, it's going to be 1.1 million. Loss on impairment 1.1 million, and decrease the copyright account by 1.1 million. Good. B, journal entry to record amortization expense for 2021. So you have a fair value of 3.2 million. Well, your carrying amount is 3.2 million now, or at least it was at the end of 2020. So 3.2 million. It has a remaining useful life of 10 years. So divide it by 10. It's going to be an amortization expense of 320,000. So you do amortization expense 320,000, copyright 320,000. Copyrights. Yep, that's exactly right. C, fair value of the copyright has increased. So you do not record the increase in fair value of the copyright. Number 16. Okay, research. Right, we have 325,000 on a research project. Right. It'll be R&D expense shown in the income statements or in a note. B, completed the project. We have obtained a patent. We have R&D costs to complete the project. So 16,000 is going to be the patent. Right. So the 110,000 is going to be R&D expense. So we're going to have R&D expense 110 and cash 110. B. Or it could be accounts payable, whatever. And then patent is 16,000. So we have patent 16,000, cash 16,000. And then we have patent amortization for 2020. So we have 16,000 divided by 10 years. 5. So 16,000 divided by 5, and then you record amortization expense, patent. It was G6. This divided by 5. Yep. Oops. Oh, no. Please don't mess it up. And then what? C. Company successfully defends the patent at a cost of $47,200 and extends the useful life. So what you do is add that to the carrying amount. So you take your 16,000, subtract 3,200, then you add 47,200, or so. Well, no, yeah. But for the journal entry, all you have to do is patent 47,200, cash 47,200. And then for amortization, it's going to be kind of hard because first of all, you need to add 47,200 to the carrying amount, and the carrying amount is 16,000 minus the previous amortization. So you add those two numbers, and then you have 2021 through 2028. So it's going to be 8 years. So you divide that amount by 8 to get depreciation per C. So, oops. Um, 60,000. So I got this minus this plus this equals the book value. Then this is going to be that divided by 8 years. And there you go. Got it. Good job. Stop. Additional engineering and consulting costs incurred in 2021 required. Looks like you do R&D expense again. Yippity skippity. And we have finished chapter 12. Yay! There's a couple of really hard questions, or maybe just one really hard question on the assessment. But I'll just look at that if I have time later. I want to go to chapter 17 now. That was funny. So it took me... Did I make any changes? Yeah, I don't know. So it took me 32 minutes to study one of the 2 chapters. We're making good progress. That was funny. Chapter 17. Oh, there might be a lot of questions from this chapter. I don't know. I remember the homework for this chapter was very easy, though. What the heck is this? Look at all these sheets. Oh, great. Oh, yeah, so here's the assessment. Oh, yeah, you know what? It was so dumb. I hated how they did that. They were dumb. Because what they would do is they gave you the wrong number, and then you had to account for the fact that you had the wrong number by adjusting the number in the last 4 numbers here to get your number back up to the correct number. Which is so stupid. So incredibly stupid. I don't know if our professor is going to want us to do that on the test. I'll probably have to do that on the test. Dang it. Anyways. So I think I know how to do this, but it's good to check how to do it and stuff. Oh, geez. Stop lagging. Oh, there's so many questions from chapter 17. Oh, no. 17.3. Oh, man. I have to, figure out what's the difference between held to maturity securities. There's all these different types of stuff. Stop. Darn it, I need to look at these summaries for some stuff here. So we have types of securities. We have debt and equity securities. Oh, jeez. Oh my gosh, what? No plans to sell, amortized costs, plan to sell, fair value. Oh no. Why did I think this was going to be an easy chapter? We have different types of debt investments. We have held to maturity, trading securities, and available for sale. If we have held to maturity, you use amortized cost. And you know how you calculate amortized cost? Using this thing here. This. Held to maturity is going to be amortized cost, unrealized holding gains or losses, not recognized. Oh my gosh. Available for sale security, fair value, unrealized holding gains or losses will be recognized as other comprehensive income. So, available for sale. Fair value, unrealized holding gains and losses are going to be recognized as other comprehensive income. Trading securities will be recognized, and the unrealized holding gains and losses of trading securities will be recognized in net income. Man, please. They always give you the wrong number in the homework questions. It's so annoying. So, if you have 8% bonds purchased to yield 10%, the first number is the payments. The payments will be the 8%, right? The interest revenue will be based on the 10% yield, and it will be based on this carrying amount, whereas this 8% is going to be based on the purchasing, or the book, well, not carrying amount, but the future amount or something. So then you take this minus this. Okay, so what you actually do is, well, you take the difference between these, but then you either add or just subtract it based on different factors. But anyways, so that's not too bad. I remember how to do that. Let's just look at all these journal entries. That was fun. So basic, oh, we stopped saying basic. So the first, and you record this number as either increasing or decreasing debt investments. And end of year, interest receivable, debt investments, interest revenue. Selling price of bonds. So is this the book value of the bonds? Amortized cost, add discount amortized for the period, and you have gain on sale of bonds. So available for sale, you record the unrealized holding gain or loss dash equity, and you use fair value adjustment. So you use fair value adjustment for available for sale security. And remember, fair value adjustment is an account where if it's at a certain number and you want to, and then you figure out that the fair value is a certain number, then you have to get from that number to the new number rather than just recording the new number. I hate myself. That was funny. All right. Right. If you have little influence, you use fair value method. If you have significant influence, use equity method. And then if it's 50% to 100, it's consolidation. Okay. Fair value, equity, consolidation. So unrealized holding gains or losses for holdings that are less than 20% recognized in net income. Then, if you have a holdings between 20 and 50%, if it's significant influence, the unrealized holding gains or losses not recognized. Good. So, I think I remember how to do that stuff. Equity methods. Yeah, so for equity, so for fair value method, net income, you record your percentage of net income. Oh. And if there's a change in fair value, if it's fair value method, you show the change in fair value. So, and if it's cash dividends, you have fair value method, it's cash dividend revenue, and if it's equity method, cash equity investments. Net loss for the company, record investment loss, equity investments for equity method. You have fair value, no entry for this one, but for this one it's unrealized holding gain or loss income, and fair value adjustment for that one. And then fair value option. For the fair value option, so for the quote-unquote fair value option, you do not have fair value adjustment. You just directly increase or decrease the investment. So impairment of value. Okay, so this one's confusing because so for impairment value of debt investments, it's weird. You do the same thing as you just basically treat it as if you're doing the bad debt expense thingy for the other one, and allowance for doubtful accounts. Oh, geez. Oh, man. Debt investments reported at amortized cost follow the same approach as the bad debt expense thing. So, decrease debt investments by $200,000, and the Debit is going to be allowance for doubtful accounts. Says new cost basis of the investment in debt securities is $800,000. Weird. This is very weird because does that mean you're not going to amortize it anymore? You're just going to leave it at $800,000 for the rest of its life until some other impairment occurs? Weird. Is that really what they mean by that? That's for held to maturity. For available for sale, what do we do here? So, amortized cost. I don't know if I need to know this because I don't know if this was even on the thing. Okay, so for available for sale, we're going to do okay, I'm just going to wait until I and we didn't have a single question about reclassification adjustments on. Okay, so let's just skip to the questions finally. Man, I don't know if I should have done all that stuff. 17.3. Purchase 12% bonds having maturity value of $300,000 for this stupid number, which is wrong. Thanks. Okay. Do every year that you amortize it, and oh man, like he better not give us a question where it's the payments are more than once a year, because so the date of bond purchase we have, what do we do? So they purchased it, so it will be, is it 300,000? To use the 300,000? No, I think you use 322,744.44 debt investments, and then cash of. Oh great! Oh great! Dang it! This is not good. Oh, so you do just do that. It's just you simply. Oh, you know what? I think 17.3 might be one of the ones that was from the email. Right. So I was correct. Hopefully, yeah, I'll have to double check to make sure all the other ones are correct. But yeah, I was correct. Debt investments, this number of cash, this number. You do not record the 300,000 just yet. B, bond amortization schedule. So I think I double checked my schedule and it was correct. Well, it wasn't quite correct because basically well, first of all, my numbers were slightly off here. I don't know how that happened. It was like a rounding error. But secondly, the book is dumb because they give you this number, which is not quite the right number. It's rounded maybe? Or no, it wasn't rounded. It was just simply off. I don't know why the book was completely off there, but it's off by like a fraction, like a tiny little amount. So at the end, you're going to end up with this number. So basically, not basically, just increase this by the amount to get it up to the correct number. And then do you increase or decrease these? Let's see what he did here. Because this could happen on the test, which is very dumb, but I'll have to just deal with it if it does happen. Rounded by 45 cents. So did he increase it by 45 cents? Yeah, so he increased this number by 45 cents. That ended up with this number, and then it ended up with 300,000. So if you're, let's see here. If you're off by 45 cents here, you need to increase by 45. Increase this by 45, which will end up also increasing this by 45 cents, which is very dumb. You should not have to do that. This number was wrong from the start. That's why you're off by 45 cents. But anyways, I know how to do this. You have to do date. Your first one is just this. Receive your cash, and this is going to be 12% of 300,000, and this is going to be 10% of this number. And then you do this minus this equals bond premium amortization, or it could be bond discount amortization. Depends. Then you do this number. You do this number minus this number to get that number. And then repeat the process until you get to the bottom, and then make any adjustments because they gave you a stupid number at the top. They're stupid, and they give you the wrong number, so you have to make a stupid adjustment at the bottom, but whatever. And that's how you do it. Okay, prepare a journal entry to record the interest, revenue, and amortization at December 31st, 2020. So at December 31st, 2020, you will have, let me think about this here. So what you will have, your journal entry, is that you have accounts receivable. It's not accounts receivable, is it? Wait a minute. What is the 36,000 recorded as? It's not accounts receivable, it's interest receivable. Close. Very close, but not quite. There, it's interest receivable. Stupid idiot. So you have interest receivable of that number, interest revenue of this number. The difference is this, and this is going to decrease debt investments. That means you will credit debt investments of that number. So you have interest receivable that number, credit debt investments of that number, and then credit interest revenue of this number. Journal entry for 2021, same deal. It's exactly the same thing that I just did for C. So we're done with 17.3. Now on to 17.11. I need to double check that it's correct. I did it correctly. This is the perfect time for this to happen. Perfect. So 17.11. Gotta double check that I got the right answer. Oh, I did something wrong. No. And 17.11 was not one of the ones in the thing. So let's see. Dang, now I have to figure out what I did wrong in that question. Oh my gosh. Okay, so when you purchase these securities, I guess, are you just going to combine all these three into one entry? Oh no, because they're 3 different days. So it's going to be 10,000 times this number plus 1980. I know how to do that. It's very simple. Secondly, security sale on the 20th. So here's the thing about that one. They didn't sell all of the shares. They sold 4,000 of the shares. So take what you did. Well, what I did was like 4,000 times 35 minus the cost of selling. Gain on sale. Okay, and then the equity investments decreased. So we have 4,000 times that. The original plus 4,000 divided by 10,000. What I could have done, and it doesn't matter. I know how to do it. I was able to do it, that one correctly. The only one I did incorrectly was the last question. So let's see. Unrealized gains and losses on the 20th, on December 31st, 2020. They sold what? Okay, how did I mess that up? Do I have to do this question all over again? How did I mess this up? Sanchez. I messed up Sanchez somehow. Let's see, what did I mess up on Sanchez? Yeah, obviously I messed up Sanchez because it was the one where he sold the shares already. So you have 6,000 shares remaining. Okay, so you have your original amount. What did it say? We have fair value per share. So you originally purchased Sanchez. Dang it, where was it? Your original amount for Sanchez was this. Then you do this minus this to get this number, although you could just do this multiplied by 600 divided by 10,000. Let's see if you get the same answer either way. Yeah, same answer either way, but you have your new carrying amount, which that's the reason I got it wrong originally. I was an idiot and forgot the fact that I sold 4,000 shares because I'm an idiot. So you have your new carrying amount. So what do you do with the new carrying amount? You take that, compare it with the fair value. The fair value is 30 times 6,000. 180,000 is the fair value. And so that means since the fair value is less than that, the difference between them is a loss. Loss of 22,188. Then what you do, now it's so stupid for some reason, like when I originally did the problem, I recorded a loss as a gain and a gain as a loss. Like, what? But anyways, you compare the fair value with the cost and record either a loss or a gain, sum them all up, and you either get a loss or a gain. If it's a loss, you record it as a debit. Loss is recorded as a debit because it's like stuff, and then the fair value adjustment. So now I know how to do 1711. Number 1712. And why is it fair value adjustment again? Let's see, what type of security are we looking at? What these are equity investments. And for equity investments, the default way to deal with the equity investments is the fair value method, which is involving the fair value adjustments. So that was funny. 1712. Right. Acquired 10,000 shares, 10% of the shares. Cash dividends are recorded. And net income, 122. And at the end of the year, it was... Right. This is very easy. I know how to do these. These are just like... So first you bought the securities. Second, you got dividend revenue. Third, fair value adjustment, 40,000. So, yeah. And if you have a gain, you record it unrealized holding gain or loss in the credit column. Okay. And then second situation is going to be equity method. So for equity method, for the dividends are going to decrease your equity investments, and the fair value will not affect anything. Change in fair value will not affect anything, but if you have net income of your subsidiary, or whatever, it's not subsidiary, but whatever, the net income will increase your investment income, or it could increase your investment losses or something. And that was funny. So we have equity investments, cash, equity investments, that's the dividend, and this one is the income. And make sure when you're doing that, you must not do the full amount of income. You have to, and the same goes for dividends. That's the mistake I made originally. You have to make sure that you take the percentage of your shares, multiply it by the total number to get your number. So I know how to do 1712. 1712. Good. That was funny.